It's been a couple of months since I last released a portfolio update. Since then it's increased in value but without any new money going in at all. In this video I'll show you how the different sectors and companies have performed. I'll reveal everything I've been buying and selling this year, and finally I'll compare my own performance to a range of indices. There will be full transparency as I have a record of every penny that I put into my Barclays platform, and I've never taken any money out. The aim of this video is to help you think about your own investing journey and should not be considered financial advice. I've been building my dividend portfolio since 2009 by investing spare money each month into mainly UK large cap companies who pay reliable dividends. Some investors prefer the lure of capital growth, but I find dividends highly motivating and it allows me to stick at it for the long term. I reinvest the dividends and let them compound and grow over time. I'll describe each sector in ascending order of performance this year so far. In the chemical sector, I only have one company, Croda. It's had a terrible time recently, but I've been buying in for the first time this year, hoping to pick up a bargain for the long term. As I go through the slides, this figure shows the average year-to-date price change in the companies I hold in a given sector. It's only based on the companies I hold, not the industry as a whole. This figure shows how much money I hold in a company. This figure is how much the price of the shares has changed this year, and because Croda is the only company I hold in the chemical sector, it will be the same as the figure at the top of the screen. Finally, here is how much this company pays out each year in dividends. So in this case I hold around £3,800 in Croda, so I would expect to receive a dividend of around £60 a year. The next worst performer is the insurance sector, down nearly 24%. Aviva did return a chunk of capital back to shareholders early in the year, but overall the sector has had a tough time. In the retail sector I have just one company, Tesco, and it's down 21% this year. It should be a safe bet over the long term, but this year has been very difficult. Now for the consumer goods sector, down 8.5%. I have three companies in the sector. First, the two giants, Diageo and Unilever. As you will see shortly, I've been buying plenty of these two throughout the year, as I see the depressed share price as a bargain for the long term. They should continue to churn out reliable dividends for many years to come, and that's just what I'm looking for. In times of recession, consumer staples tend to do better than most. Haleon is the third in the sector, and I acquired this recently from a corporate spin-off by GSK. Haleon's brands include the likes of Sensodyne toothpaste, Panadol painkillers and Centrum vitamins. Next is an exchange-traded fund. This one tracks the S&P 500 and is down nearly 5% this year. I've been buying it on a regular basis for a bit more global diversification. In the mining sector, I only have Rio Tinto, which is down 4.6%. Over the years, I've found this sector highly volatile, but I'm happy to hold Rio as it's one of the strongest companies in the sector and has a relatively good record of dividend payments. Another ETF now, and it's the FTSE 100. This one gives you exposure to the whole index. I like ETFs for diversification, but I also like individual shares, so I can snap up bargains when they emerge. The banking sector is down 2.5% and I have four companies. Very mixed fortunes for these two. Barclays has dropped almost 13%, while HSBC has risen by almost the same amount. Lloyds and IG Group are also negative for the year, but their dividends are fairly reasonable at around the 5% level. Rising interest rates should help the banks make more profit. Down 1.9% is the utility sector, with National Grid slightly down this year and SSE slightly up. Both pay a dividend of around 5%. In times of recession, the utilities are another sector which tend to do better than most. The water supplier United Utilities is also down this year. The aerospace sector is down a touch this year at 1.7%. The difference in fortunes between these two companies is vast, with BAE Systems benefiting from many countries around the world boosting their defences and Rolls-Royce being dragged down by troubles in the aviation industry. I've been buying Rolls-Royce this year as I believe air travel will eventually get back to normal one day, and as I'm a long-term investor, I'm prepared to wait. My newest holding is an ETF, VHYL. I'm primarily a dividend investor, and this ETF gives me global diversification as well as a stream of dividends from companies from around the world. The yield is 4%. The best performing sector in my last update was Big Pharma, but it slipped to 4th place this time. I have two companies, AstraZeneca and GSK. GSK has recently spun off a separate company called Haleon. The food and tobacco sector is up 9.5% this year, with the share prices of these two companies rising strongly. They also pay very high dividend yields. Tate and Lyle is down on the year, but it has sold some businesses and returned money to shareholders. It's a well-run company and should do well in the long term. Up 12.7% is the renewable energy sector, which has done extremely well this year. Bluefield specialise in solar power but are also branching out into wind and battery storage. Greencoat specialises in wind energy. The third company I have in this sector is the Renewable Infrastructure Group, and they have wind as well as solar assets. And the highest performing sector in my portfolio is oil and gas, up an incredible 33%. This is one reason I like buying individual companies as well as ETFs. During COVID, the price of these two plummeted, and I started buying more. Since then, they have recovered strongly and have been the main driving force in terms of capital growth. I'm now going to reveal all my purchases this year, month by month, and all I ask in return is a quick tap of that like button, as it really helps out the channel. Thank you. With my shares paying well over £1,000 a month in dividends, I don't always have to put new money in. I also received a return of capital from a few companies as well as a couple of sales, but more of that later. In January, I bought Croda, Diageo, Unilever and IUSA, which is an S&P 500 ETF. February saw me continue to add to Unilever and Diageo, and I also made a move on BP and HSBC as I saw they were rising with momentum. In March, I bought Royce for the very first time. It looked like a bargain and I'd been monitoring it for months. I thought now was the time to pounce. In April, I bought more of my old favourites, which looked like bargains. In May, I added to the utility sector as well as the American ETF. More big purchases came in June, and in July I added to British American Tobacco and Imperial Brands as they had momentum and strong dividends. In August, the Croda share price was really having a bad time, so I did a bit of dollar cost averaging and simply bought some more. I did the same with Royce, and a new ETF called VHYL was purchased too. And so far in September I bought, you guessed it, Unilever and VHYL. I said earlier that I liked individual shares as well as ETFs, as I can snap up bargains when I see them. Just look at how many purchases I've made of Unilever this year, and now look at what has been happening to its share price recently, and perhaps you can see the benefit of being able to snap up bargains when they emerge. I did a similar thing with oil during COVID, and this year BP and Shell started to dominate my portfolio, so I gave them a bit of a trim. Research shows that those who rebalance their portfolios tend to make an extra 5%, which may not sound much, but over the course of a lifetime, 5% is huge. Cash within the portfolio has now been reduced to £1,300. Since the last update, no new money has gone in at all. I was still buying shares, but the money was coming from within the platform from dividends, sales and return of capital. Despite no new money going in, the portfolio value still increased by £5,250 in 2 months, or a 1.6% gain. Now let's look at the performance this year so far. At the start of the year, the portfolio had reached just over 301k, and this September it's at just over 341k. Just over 11k of new money has gone in this year, so despite all the volatility and panics in world markets, the portfolio is showing a gain of over 29k this year, or nearly 10% in total return. Now let's compare the performance of this portfolio with other indices. To do this, I'm going to strip out any dividends I've received this year. This still gives me a gain of 6.6% this year. You can see in this table how the performance compares to other indices. A word of caution, however, I've clearly beaten the market this year so far, but that doesn't mean I will over the long term. Oil has done well this year, but there will come a time when it will underperform and my success against the markets may be short-lived. Having a diversified portfolio over many sectors is important, and I've been really getting into ETFs recently. And now my overall performance since I started in 2009. Yes, I made plenty of mistakes in the first few years as I was learning, and we can all do better in hindsight. I've drip fed in a total of 220k since the start. The current value today is 341k. giving me a gain of over 121k or a total return on investment of 55%. It's not the capital growth that I focus on, however, it's the stream of monthly passive income which inspires me to continue. The portfolio is now producing an average of over £1,000 a month in dividends, which I like to put straight back to work. Please give this video a like if you found it useful and consider subscribing for future updates. See you next time and happy investing.